Okay, so now we're on to episode 3 in the capital market series. This could be discussing corporate strategy and behavior in the marketplace. I'm going to jump right into it to keep the video short. Hopefully I don't ramble too much, but I think there are a few things that need to be addressed here. I get a lot of phone calls. I speak with a lot of shareholders, as I previously said. One thing that comes up quite a bit are buybacks and dividends, as well as a few other things we're going to get into future videos on splits and restructuring, et cetera. But right now, we're going to talk about buybacks and dividends and if they're good or if they're bad, and I'll let you determine that, and I'll give you my opinion. So, buybacks. So, this is an interesting one. I understand that why people are asking this question. So, let's talk about what a buyback is. It's a company going into the marketplace and buying its own stock. Well, why would a company do this? Do they want to restructure? That could potentially, maybe they want to decrease the authorized, they have a surplus or a strong cash position, and this is a strategy they want to employ. But for the most part, what you're doing is you're decreasing the supply. So it's a very clever way to decrease supply and increase the demand through whatever announcements or whatever is happening within the company's business model that's being executed at that moment. But it's a way to increase the share price. Isn't that really what it's ultimately about? Right? So you're buying your own stock, you're decreasing the supply, so now there's not enough of it out there, or there's a less amount out there, and the stock price goes up because it becomes more expensive, supply and demand, right? So a company is now spending its own capital to buy its own stock so that the stock price can go up. And this has been the behavior for many of the companies on the S&P 500 over the past couple decade or so. And I guess the question is that really the best use of a company's capital? We'll go into that in a minute from my point of view. Dividends. So this is another interesting one. We're paying out shareholders part of the proceeds or revenues or profits to entice them into buying more. Why? To push the price per share, right? People buy more, price goes up, supply and demand. As more people buy, there'll be less available, and the price is going to go up. It's labeled as a reward to the shareholders, but the reward really is if you build a solvent company and the value increases within the company, then the price per share will follow. And for those who want to liquidate all or a portion, that's their ROI. That's their return on their investment, those gains. So those are two things I want to go into because they've come up quite a bit. And I think it's interesting that so many people are in favor of this because I think they look at it from one point of view. And I think that's kind of the point of this video. I want to take a look at it from another point of view. So when you look at what companies are doing with their capital in the trend over the past decade, you're looking at many companies are spending over 50% of their revenue. And I'm excluding companies like Apple that has a surplus of cash, and it may be a good strategy for them to employ, especially when it comes to dividends, let's say. So, but you have many of these companies in the S&P 500 taking almost more than half of their available cash position to buy back their own stock. And then on top of that, you're looking at somewhere around the 35% use of their capital is being used for dividends. So the natural question for me is you're spending in excess of, in many cases, 90%. It varies sometimes 90 to 95% of the company's capital in paying, essentially paying off shareholders and buying back your own stock to increase the price per share. Why would you do that, right? So you ask yourself, why are they doing this? Where did this strategy begin? I'm going to go over that in a minute. But when you look at these numbers, over 90% of your capital is being spent on buybacks and dividends, you have to ask what I feel is the natural question: what's left, and where are you going to allocate that cash? So what's left for hiring new people, or increasing wages, or developing new products and IP and materials, increasing your supply chain? Why decrease your cash position for when there is another issue that you might have to address? What's left, right? So is that a good strategy? So we can discuss that in a minute. So where did this all come from, right? It started coming from when we start tying people's salaries to performance, which is a good idea, and I live by that. But when you incentivize people to increase a stock share, a price, because that's what people are measuring by. And I don't think that's necessarily the most accurate way to look or evaluate a company's health or viability. For me, it's about long-term solvency. You have to build a company that will buck the trend that's happened in the past decade, where you have these venture capitalist companies coming in, these investment firms coming in. They move into a company that might need some capital funding. This has happened many, many times in the past, even just the past couple of years, where they come in, company's been around 30, 40 years, and within a year they're gone because the focus is on profits. So I'm not saying profits are bad, but there's a way to get there and there's a happy medium, right? So if you want to increase profits, what are you going to do? You're going to increase automation. You're going to decrease your human capital. There's a cost associated, workman's comp, insurance. There's all kinds of things that human, and also they take sick days, right? How inconvenient of a human to take a sick day, right? So when you have automation, you don't have any of that. You've decreased your human capital cost. You've increased your overall cost, right? There's other things that you can do by removing folks from that. But you're also going to have to take a look at how we can cut certain other costs. So maybe decreasing quality. And that when you start diluting the brand quality, which has happened, and there are many examples. I'm not going to name specific companies. I don't think that would be appropriate here. But for those that are interested, just do a little bit of research, and there's a long list. Trust me. And a good example, and not to pick on them, but they're a good example. Apple with the iPhone. You buy an iPhone now, it's $1,000 to $1,200, I think, because it's made overseas and labor costs are lower. You do that here in the United States, they estimate the phone to be between $1,800 and $2,200. So there's an increase. So what do? To decrease costs and overhead, we ship those to places, which now does what? It costs jobs here in the United States, which affects our economy. That's good or bad. That's up to the shareholders to decide and the company to decide. But I'm just trying to give you some insight as to where these decisions lead. So now we're looking at profits as opposed to long-term solvency and value, right? And this is just one way to look at it. I'm sure other people have different opinions and different ways to look at that. Obviously, I'm one person. Right? So this specific strategy of buybacks, dividends, focusing on profits over solvency and long-term viability, this is what has really contributed to the explosion in the stock market. If you look over the past 10 years, it just exploded. It's unbelievable. So these types of decisions make the stock market bigger, and it's the biggest it's been in U.S. history, right, than any other time in history. But again, from the previous video, we have less middle-class Americans in the stock market than the first boom in the stock market, where there was an explosion in the stock market to help develop the middle class. So is that good? I don't know that contracting the middle class is good for the economy. When you look at how many people were in that bracket, when you're looking at small business ownership, et cetera. So these are all things you have to take a look at. And I know people are going to say, Alex, what are we talking about the economy for? You're telling me about strategy. Because there's a not only a fiduciary responsibility to shareholders, but as shareholders, we also have a responsibility to the economics of our own country. You can't do something that takes away from the collective of all of the people in the country, right? It can't just be taking all the time. So that's a philosophy that you may not agree with. It's just one that I go on. So when you look at the trend on what investors like, you have to look at the result from the point of view of the company, but also the shareholder. So aren't we sort of contributing to this as shareholders if we want to just see profits all the time? I bring this up because I think many people are asking me about buybacks and dividends because they are so focused on price per share. So I'm going to give you a little bit of insight to my strategy on how I run the company and what I see the vision of the company. For me, the money should be used to expand the company, to hire more people, and once we have the staff we need, to eventually be able to increase their salaries so that we can increase retention and also improve not just their personal quality of life, but their work life. We have a very unique way of doing things. I'll probably get into that in another video, but we have a way of doing things here, and there's some things I'm going to be implementing once we increase staff. But the focus cannot just be you come here and do a job. In this company, we're more of a family. We all know each other. We're all very close. So for me, it's important that everyone is healthy and happy and productive. And as a result, we have people that work to the point where I have to tell them, no more, you have to stop. It's a Sunday and you're calling me. Not that I mind working on a Sunday, but I'm not going to have an expectation of my employees or my teammates working like that. And I find, and for those who write in, you'll find Candace works all the time. And it's important to understand that the personal component of a company has more value than just looking at this one single metric. So my philosophy is if you build a solvent company and you produce a quality product and you can do so with the correct margin, the company will grow. It takes time. It doesn't happen overnight. And I understand that my way may be a little bit longer than people like, but we're not going to sacrifice short-term gains for some instant gratification over long-term solvency. For me, this is a company where we can have generations of an employee's family come in and work in over time when they become of working age, and they recommend, which is the biggest compliment. You know, your son graduates college, you should come work over here with me. And it would be great to see families working together, and also in an environment that's healthy, nurturing, and also when you have an environment where people are happy to be here, I can tell you from personal experience, you produce so much more. You get so much more out of them, to the point where I do have to tell people, you're off tomorrow, you're done. And we actually have a requirement monthly that someone has to take off a Friday or a Monday, or if it's following the week, a holiday, where they have to take once a month a day that's consecutive, so they get a 3 or 4 day weekend. To me, it's more important that they spend time with their family and they're happy and healthy, and they don't get burnt out on the company. So that's my personal philosophy on how we grow a company, and it's because of that, I believe, that we've been able to do so much with so little. And I think the proof is in the pudding. When you look at where we were a year or two or even a year ago, we have grown. We've been able to really expand on the company. So for me, the best use of funds is not to buy back our own stock. That's just my personal philosophy. I understand that there's many in Wall Street that disagree with me. If we had billions of dollars in the bank, maybe I'd consider it, but we don't. As far as dividends, I understand that'd be nice to consider down the road. I'd have to take a look at how would that really benefit the company. And it's not just about the company. Let me just be very clear. But if the company is solvent and the price keeps growing, our value keeps growing, then the stock price will reflect our value, and then the shareholders experience a return. To me, that's the best way we could serve the shareholders, by constantly improving the company and improving the value, and eventually the stock price will follow. It's not instant. It doesn't happen overnight, as many of you know. And we've been here a long time, and we're continuing to run. I think the fact that we've been here this long is a statement into its own. So buybacks, dividends, corporate strategy, what's currently happening, these are all things that I think people should weigh and consider for themselves and form your own opinion. But I think it's helpful that we at least understand what they are and how they, in some instances, can impact not just the company, but the economy and the solvency or long-term viability of a company. So hopefully that helped. I know I rambled a little bit. I'm going to cut it off right now, and I'll see you in the next video.